Hi, my name is Stuart. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And in today's episode, I'd like to talk about ethical investment options. I've been asked in this podcast and on other occasions by clients about, whether it makes sense to use an ethical investment and what are the risks and what impact on future returns might that have. Now, putting aside the, moral or value-based decisions or drivers that might encourage an investor into this space, I'd like to today just focus on the investment merit. So really the risk and return of of these ethical options. And then we can, at the end of it, decide purely from a financial perspective, because as a financial advisor, of course, we need to take into account our client's risk profile, their appetite for certain investments, their comfort levels, their values, which are obviously clearly linked to this conversation. So, of course, we need to take into account all these things. But as financial advisors, I think our job is to help clients make informed decisions. And that means really understanding what are the implications if I go in this particular direction. So, if someone has a very strong opinion on, what sort of investments they want to hold, and we believe that's going to cost them in terms of returns and potentially compromise them achieving their goals, then we need to have that conversation. It's not our goal, our role, I should say, to make that decision for them, because at the end of the day, it's their life, it's their money. Our role as a financial advisor is to help people make informed decisions. And I believe, 99% of the time, people will make the right decision for themselves. It's really just the absence of information that causes mistakes. So that's a bit of a longer preamble that I planned, but that's really where I want to frame this ethical investments podcast today. So I'm going to just use the term ethical investment as kind of a catch-all sort of term. But there's a lot of terms and badges that are used for these types of products. Can be ethical investing, can be sustainable investing, can be ESG, which is an acronym I'll define in a second. But it's important to understand this is what I'm talking about, these basket of goods. When people talk about ethical investing, most people are sort of talking about investing in a way that aligns with their personal values. And in practice, that really means excluding certain industries or types of businesses, things like tobacco, weapons, fossil fuels, gambling, modern slavery, these sorts of filters, if you like. ESG, as I said, is an acronym that stands for environmental, social, and governance. And whilst it's a broad kind of umbrella term, it tends to go beyond just simple exclusions. So it covers sort of ethical and moral considerations, how a company operates, its environmental footprint, how it treats its employee, its customers, its supply chain, these sorts of things, quality of its governance. So, we've seen that with TechWise in Australia, which is a listed technology company that, that the CEO's been in a bit of strife, these sorts of things. So ESG is a bit broader than perhaps just ethical investing. And sustainable investing typically refers to more of a way of directing capital towards supporting more sustainable economies, such as renewable energies, low emissions, cleaner production, these sorts of things, reduced waste. So, we can talk about, ethical investing as, just that umbrella term that sort of encompasses a couple of different approaches that sort of lean in different directions. But irrespective, I'm going to sort of just treat it as kind of one homogenous investment approach is probably the best term to use. Now, the challenge, as we'll get to discover deeper into today's episode, is that there's no sort of generally accepted single approach to constructing a ethical portfolio. What a company might be, we might have two ethical ETFs, for example, or managed funds. In one might include a particular company that you think, isn't particularly ethical or environmentally conscious or whatever the focus might be. And another one will exclude it, right? There's no really consistent way of saying, well, this is what the name says on the product. So then my expectations are that it will exclude companies like this. You've really got to go under the hood to really see what is their approach, where do they get their data from? How often do they do this filtering? All those sorts. So you can't really compare sort of two products that could be completely different. And with respect to ethical investing and adopting ethical investing, I think investors typically fall into two camps. The first camp is, we might just call them kind of the practical camp, that their approach is, look, if I can invest in a way that's ethical, that's better for the environment, that aligns better with my values, and the risk of doing that is the same as not doing it, so taking a non-ethical or traditional approach. And if the returns are going to be the same or better, then I'm happy to include it in my portfolio, but I don't want to go to an extent where I'm changing the risk profile of the portfolio so dramatically that it potentially is going to have the impact on future returns and also then meeting my goal. And so I think most people kind of fall into that camp. Yes, let's include it because it, kind of feels like doing the right thing, but ultimately the goal is to achieve my long-term financial and lifestyle goals. The second camp is taking a more strict approach. So a more strict approach would be it's non-negotiable that regardless of risk and return, I'm just not prepared to invest in tobacco, for example, or an index that includes tobacco exposure. Even some institutions have to adhere to, really strict guidelines that requires even deeper research. For example, I know some religious bodies, have that sort of mandate, which requires then advisors to really understand the index they're investing in and understand the indirect exposures. So, for example, a listed company might own part of a business that owns another part of a business that, is exposed to the practices of modern slavery or sweatshops, these sorts of things, in emerging economies. And so they've got to go drill down to that level because the appetite is zero for any sort of direct or indirect exposure. So it really is important to kind of understand which camp you sit in, because that will dictate, how much due diligence do you need to do, how much do you need to drill down. And, it is kind of opaque, even a reputable manager like Vanguard was fined back in 24 by the federal court, and they had to pay a fine of nearly $13 million for greenwashing. So, they had some misleading claims about their ESG kind of filters and screens that they used. And I'm sure, Vanguard did its best in order to communicate this. I don't think, Vanguard's a not-for-profit business. There's no commercial incentive necessarily for them to misrepresent their products. But, it shows that even a business like that can kind of fall foul from it. And it shows kind of how opaque or inconsistent, better way to say it, inconsistent the approaches to ESG are. So if you do fall into that strict camp, you are going to have to really dig deep in terms of understanding the underlying products that you're investing in. But my sense is that most people fall into the kind of what I've called the practical camp, which is not to suggest that people that have very strong ESG views are impractical, but most people I think fall into that practical camp. And that's what I really want to focus on in this podcast, which is there investment merit in adopting an ethical approach or including some ethical products into my portfolio? Which is a good segue. Let's start talking about the investment merit behind these products. So the foundational idea behind a passive, rules-based, evidence-based approach towards investing in the share market is that it's impossible to consistently pick winners and losers, either in direct stocks or managed funds. And Bernard Melke, which was one of the founders of Vanguard, said it's like trying to pick a needle in the haystack. Instead, just pick the haystack or invest in the haystack, which is the broad-based index. And doing so gives you, a very broad diversified exposure by default. And, you hold companies that the index dictates the weight of those companies. And the argument is that as a company becomes more valuable, it reflects its inherent value. So it's driving more economic value in the long run. In the short run, markets can be irrational, but in the long run, markets are rational. And as a result, you're getting greater exposure, or more of your overall money is invested in those companies that are producing more economical value. So the main point here is simple: be very careful about straying away from the broad-based index, because that's kind of the foundational idea that if Nvidia in the US is the most valuable company in the world, then not investing in Nvidia based on this methodology, or Apple or Google or anything like that, necessarily isn't a great idea. And really what we're trying to do by hugging the index is what it's called, or sticking as close as possible towards the index, we're trying to avoid taking unintended bets. If you decide I'm never going to invest in the US market again, the largest developed market in the world, then, that's taking a pretty significant active bet, which goes against the rules-based, evidence-based approach towards share investing. So that's the first kind of port of call or first consideration that I would look at when considering ethical product. What I want to understand is, does it behave like the parent index? So for example, if I'm looking at a global ethical product, I want to have a look at what the underlying exposure to both geographical markets, so how much is in the US, how much is in the UK, how much is in Japan, so on, and then the sectors, how much is in technology, how much is in financials, again, those sorts of things compared to the parent index. So if I'm looking at a global ethical fund, I'm probably going to compare it to the MSCI World Index, for example, or whatever reputable index is a broad benchmark for that particular type of approach or asset class. And probably if you're going to look for what is a reputable index, maybe look at some of the Vanguard funds, particularly ones that have been around for a very long period of time. So Vanguard Australia, which follows ASX 300, or, the Vanguard International Index, which follows the MSCI World Index, MSCI Index. So that's typically kind of the best way to identify what a reputable index is, because if Vanguard's using it, you can be relatively sure they're pretty confident with that the index represents the underlying exposure. And remember, the goal of an ethical fund is not necessarily to beat their parent index. So again, it's not necessary to produce better global returns than the traditional market cap index. The goal is really to give you the same exposure as that traditional index, whilst excluding companies that kind of fail those ethical screens. And if implemented correctly, an ethical approach should not really materially change the underlying portfolio's risk, and also shouldn't change the future expected returns. Now, whilst that might be true, we need to think about the investment merit of taking this approach. And there's an old investing line that says, where money goes, returns flow. And really, that's very present in all markets. So what happens normally is a market starts to move, and then most people are late to the party, but then people then go, oh, that sector of the market's doing really well, or that geographical property market, Brisbane's going gangbusters, or Perth, I'm going to jump on board. And that stimulates, so that additional capital that's attracted as a result of that past returns, or those past short-term returns, drives that performance. And you can clearly measure money flows. A lot easier to do it. Well, you can do it in the property market as well, but really you can clearly measure money flows, and that sort of shows where that short-term return will be. And that's how that sort of term came about. But essentially, it is true that, if you're going to have a particular index or approach or a basket of companies that are going to attract a greater share of the overall capital, then it is reasonable to assume that they're probably going to generate better returns. And it's just because supply demand, right? So if I'm looking to invest in a financials business and I want to apply an ethical screen, and there might be 50 financial businesses in a particular index and only 4 of them pass the screen, then a lot of money is going to go into those 4 companies, because, the investable universe is pretty small, and they're going to sort of gobble up all the capital, if you like. If I relate it to more of a traditional business, I've got a friend that runs a commercial fund, and they build offices for government tenants, and government tenants want a really sustainable building now. It's called a neighbours rating, and they need a 6-star, or mostly want a 6-star neighbours rating. And so from an ethical standpoint, his business, compared to a traditional business that builds office towers that aren't highly rated, is going to start attracting more and more capital. So that's an advantage for that business. So I think the more sustainable, more ethical a business is going to look like, the more capital they're likely to attract. Also from a retail perspective, and also from a institutional perspective, I think there's greater pressure to push more money into this space. And so whilst I think there's a legitimate reason for applying an ethical approach from a personal perspective, I think it adds to the thesis that ethical funds will be attracting a greater share of the future capital, and as a result are probably then going to enjoy better returns just from that supply-demand dynamics. Now, that's the thesis. That's my thesis. But as you should know by now, it's got to be rooted in evidence, right? So let's go and have a look at the evidence. And what I've done is I've had a look at the ETFs or managed funds that have at least 10 years, well, at least 7 years. They haven't all been around for that long, but around 7 to 10 years worth of data or history. And I did the same for industry super funds. Well, actually, I've got some non-industry super funds in there as well. But again, looking for those ethical ethical options, whether it's a premixed option like growth, ethical growth, or ethical balanced. And again, looking at options that have been around for at least 10 years, because again, we want that level of data. In fact, we probably want more data than 10 years because it's been a pretty decent 10-year period and the tech companies have done pretty well. So it's not like oil companies have done well, and the oil companies have been sort of up and down over that time. So we've got to think about, the period of time we're comparing, what has happened over that period of time, and are ethical businesses more likely to outperform or less likely to outperform? I guess you could probably say over the 10 years we've had nearly 5 of those years Trump has been president, and we know he's not particularly enamored with green energy, particularly windmills. He keeps talking about windmills. But so, you probably would think, and we've had Biden for the rest of the time that was kind of pro-green energy. So you probably think it sort of evens out a little bit. It's probably been an okay sort of 10-year period to measure these returns. I feel like I'm rambling a little bit, but essentially what I'm saying is it's great to look at past performance, but then you've got to really understand what happened over that period of time. That's what I'm saying. Okay, what did I find? Well, I looked at some beta shares products and ETFs, and I tried to pick, something that's relatively comparable, to as a traditional sort of ETF to compare against. And interesting, in Australian sustainability underperformed significantly, where global outperformed significantly, like 17% over 7 years versus 16%. So you'd sort of say, well, it worked on a global level, but not on an Australian basis. The consideration there might be the Australian market's just too small, perhaps, for those filters. Then I looked at Dimensional. Dimensional are really good to look at because it's a US fund manager that's evidence-based, that uses a slightly different sort of approach to indexing. So it starts with an investable universe and then skews an index towards smaller companies, better value, higher profitability, these sorts of fact-based measures that they believe, or their research shows, that expose a portfolio to higher returns. So Dimensional is a good one to use because their core competency is portfolio construction. As far as I'm concerned, that's my assessment of them. And so when you look at both the Australian and global sustainability funds versus their traditional funds, there's about 2-ish% outperformance over a 7-year period. The sustainability funds haven't been around for 10 years yet. So you'd certainly say, okay, sustainability can outperform significantly, but it really depends on the approach and fund manager. And similarly, when you look at Vanguard's ethical funds, well, its global ethical fund hasn't been around for 10 years, a sort of similar timeline to Dimensional, really, and it's only slightly outperformed, whereas its Australian fund has underperformed. So over some periods of time, not all. So you might sort of say, from this data, the ETFs and managed funds are outside of super, you might say, well, a sustainable approach in Australia might not be the right approach, perhaps because the market's too small, but adopting a sustainable approach in global exposure might be worthwhile, but we have to be very careful about who the manager is and how that product is put together. And then we look at super investment options. 3 out of the 4 industry funds outperformed. Their sustainable option outperforms. So I looked at Australian Super, I looked at Aware Super and UniSuper. They all outperformed. Hester slightly underperforms, but not by a big margin. So I guess in the super area, you could conclude that, yes, ethical investing could outperform. But again, it's going to really depend on the manager. So for example, if you look at UniSuper High Growth, sustainability option over the last 10 years outperformed 2% by more than 2% per annum. That's substantial outperformance, right? So that might give you some evidence that, yes, it's possible the thesis that, where this capital is going to drive returns, but it just shows that, what you really need to do is have very high confidence on the fund manager's ability to be able to deliver those returns. Now, putting aside industry super funds, which, they're managing the mix, it's important to really consider, because of the investment menu, if you do adopt this approach, what do you forgo? Well, most of these, in fact, all of these ethical funds typically use traditional market cap indexing. And I've spoken about my concern with traditional market cap indexing previously. That is the Magnificent Seven, the big 7 tech companies in the US, now make up an outsized proportion of the total market. And the value of these, some of them multi-trillion dollar businesses, I think Apple and Nvidia are worth more than $4 trillion each, which is, just insane, really. They're making up a greater portion of the overall market, which creates that concentration risk. And they're not bad businesses per se, but, and some of those businesses, they've had significant earnings growth. And so you'd say, well, maybe they deserve the high multiple, but some of them, even despite their high earnings growth relative to their multiple, they still look expensive because, some people sort of cite, well, the AI trade, AI is going to be very productive. There's a lot of profit there, which is great. And it's true, but it comes down to growth at a reasonable price, not growth at any price sort of mentality. So as a result, I've made a case for using alternative index rules-based strategies. So maybe a value approach. So I'm still getting access to growth technology companies, but ones that are more reasonably priced. I might use a quality approach, which means, okay, even if I'm buying something that's overpriced, at least it's going to be really good quality rather than something that's overpriced that's terrible. I might use other factor sort of approaches like dimensional that I've just spoken about. But the problem with this is that you can't do that in the ethical space. So you can't buy an ethical fund that's quality as well. Those products just aren't available yet. Also, if you want to target, you want to start getting a little bit overweight a particular geographical market, the product limitations can impact you there as well. So, for example, 5 years ago, we really liked the UK market because it was cheap by historical standards. And a lot of those listed companies on the FTSE 100, in the FTSE 100 index in the UK, are still global businesses. They've got global revenues. It just means they're listed in the UK and they were trading at much lower multiples than comparable companies, say, in the US. And so there was a bit of a valuation gap there, and we liked that from a long-term investment perspective. And it's played out really well over the last 5 years. It's the best performing developed market geographically, and it's beaten the S&P 500 index on an unhedged basis over the last 5 years. So that thesis has worked out really well. But we had some clients that had strict ethical filters and didn't want to invest in tobacco, for example. And so British American Tobacco, BAT, is a top 10 company on the UK stock exchange. And so we couldn't get that exposure for that particular client. Now, look, they're okay. Their returns have been good. We still use dimensional, those sorts of things. But it does show sometimes that because of the limited product menu that you have, you can't employ the same rules-based, evidence-based approach to portfolio construction that you can use if you didn't require that sort of ethical approach. So that just might mean you might use this ethical approach in a different way. And so how would I do it? Well, I would say that, look, I think my thesis holds true. I mean, the evidence isn't overwhelming, but I think perhaps that's a criticism either of the geographical market, the ETF or managed funds trying to play in, or the lack of skill of the manager. But I think there is evidence to show that sustainable funds have outperformed. Not across the board, but if you're looking at the quality managers have outperformed. So I think that fulfills my thesis that these things will continue to outperform because they're going to attract a greater share of capital. So I think there's a investment thesis there. I think that if you try to employ a ethical approach across the board, so 100% ethical, you're going to make some compromises. You're making compromises both with fund managers. So you're going to end up using maybe 2 or 3 at best different managers. And so that's not spreading your sort of fund manager risk. And you're probably going to be almost certainly forced into using mostly traditional market cap indexing. So that means that you can't really use or pick the investment approach that aligns with the risks and opportunities in particular geographical markets. And as a result, your portfolio at times is going to be higher risk and potentially lower returns. So I don't think you can do it across the board unless you've got this strict criteria. What I think you can do, though, is build it into your portfolio. So if you've got some core holdings, you say, well, I'm happy to have like 30% of my portfolio invested in traditional market cap indexing. Then what you might do is say, I'm going to choose an ethical fund that has a track record of outperformance relative to its traditional version. And I'm going to use that as my traditional market cap indexing. And then I'm going to build, that's your core exposure. Then I'm going to build kind of satellite exposure. I'm going to add some, value-based indexing. I'm going to add some dimensional. I'm going to add some quality. Whatever you're going to do in terms of construct that that portfolio, but at least you're including some of that sustainable approach. Not necessarily because you're driven to it because of your core values or, your approach from that perspective, but mainly because, you believe that, in the future, you think it will attract more capital. So then sum up today then. Ethical investing, yes, can outperform and there is merit as long as the portfolio closely represents the parent index it's trying to align to. You've got to be very careful about understanding the approach. So you want to understand how they've constructed a particular index or what sort of approach the manager uses and what sort of historic performance they've produced. And then lastly, it's probably not a case of adopting across the board unless you're looking at a particular, pre-mixed investment option inside super, for instance. But if it's portfolio construction outside of that arena, it's probably not adopting it across the board, but it's probably a core satellite approach, as in my core holding that I'm happy for it to be in traditional market cap indexing, that's going to be sustainable. And then the rest of it might be, a more traditional approach. Okay, I've got time for one question. It's a bit of a long one from Rob here. Gives me great feedback on the podcast, so thanks so much, Rob. I'll give you a quick rundown of Rob's situation. He and his wife are both 46, no kids, earn $250,000 each, so really strong incomes. They've got net investment assets. I've got investment assets about $7.5 million with about $3 million of loans, so $4.5 million of net investment assets. Target is to spend $150,000 to $200,000 in retirement, and they'd like to retire in about 10 years' time. So those net investment assets, there's 3 lower grade units, I think apartments or units, in a lower socioeconomic area of Sydney. They're worth 1.7 with 700,000 of debt, 5% yield and only 3% growth. So I think we all agree, probably people listening on this podcast, they're not the right assets because it's not compounding capital growth, too much income. But it's a sign, I think, for people to understand that if you're going to accept a higher amount of rental income, you're probably going to do that at the cost of accepting a lower amount of growth. So if you look at the total return there, it's 8%. I think that's pretty reasonable. It's what you'd probably expect. It's the split between that 8% that's really going to, the type and location of property you buy is going to dictate that split. Okay, they've got 3 better investment grade houses, Central Coast, Ipswich and Logan, so all in Queensland. Value 2.7, 2 mil of debt, yield around 3% and growth is 5 to 6%. So there you go. Again, sort of 8 to 9% returns. Houses versus apartments are going to give you better returns, but again, a split of rental yield and growth. Combined super 1.1 and 250 grand of cash. Okay, so Rob's plan is to convert his super into a self-managed super fund and go and buy 2 investment grade properties inside super, roughly $1.2 million each. So I think we're looking at probably houses there, I would guess. He doesn't like shares much, and he feels having properties in Melbourne, Brisbane and Sydney gives him good geographical diversification. I didn't mention his home. It's worth $2 million with $200,000 of loan against it, and that's not including the investment assets. And also, I forgot to mention he's got a share portfolio of $250,000. And then his plan is to stop working at 56, sell one of the lower performing properties and kind of live off those proceeds, and then potentially sell some property inside super at age 63 or whenever he kind of needs it. And what he's asked is, what would I consider in terms of his plan? What are the sort of holes or concerns? Am I happy to be all into property and maybe a commercial property inside super instead of residential property, and sort of any other comments? Let's start in reverse order, commercial versus residential. I'm not a big fan of commercial at the moment, particularly in that price point. So it's very competitive. So if you're looking at a commercial property of say 3 mil or less, $0 to $3 million price point is very competitive. And I just don't think it represents value. I was looking at one yesterday, in fact, it was selling on a 5% yield or cap rate. It's absolute nonsense. You're never going to get a good return from that asset. I'm going to do a podcast episode about it, and I've been saying this the last 2 or 3 months, but I'm just really unpacking it in my head. I want to make sure, I put a coherent evidence-based sort of episode about it. So I'm going to get there, but I just don't like commercial in that space at this stage. They're just not, the yield's just unattractive from my perspective as a sort of general sort of comment. Rob said he doesn't like shares. Okay, I hear you, Rob, but I don't think you have to like them. You're not dating them. I'm being a bit facetious there. Look, I just don't think. I think everyone would just be. I mean, I know. If you came to me with financial advice, that is your personal preference. My role as a financial advisor is to tell you what I think is most prudent. And what is most prudent is you spread your eggs amongst different baskets, and to put all your wealth into the residential property market in Australia is risky. And we can say, look at the last 45 years, Stuart, of data, and 100%. Like, if you buy well and you hold it for many, many decades, probability are, in fact, high probability, more than 80% chance, you're going to do really well. But it just doesn't make sense. Having that concentration risk in any portfolio never makes sense. There's never a basis for it. So if it's because you don't like shares, I think maybe you've got to address that rather than reflecting that in your portfolio or asset allocation. So, and I think if you had all your property in Melbourne in over the last 10 years, or you had all your wealth in global share markets over the last 10 years, you're in completely two different positions. And so I think there's no better example there. I acknowledge, Rob, you've got geographical diversification, Sydney, Melbourne, Brisbane, and I think that's fantastic. And it really comes down to the quality of the individual assets that you're buying as well, because it's true that even in a flat market, you're still going to get assets that outperform. Remember, the median performance in terms of growth is really just the middle. It means 50%, potentially 50% or more properties have outperformed that median. So it's true you can outperform a market. And I'm going to write a blog about that and do an episode about that over the coming weeks as well. But, it's nice to invest in a rising tide, where the market's doing well. So I think adding some more liquidity into your asset allocation would maybe put you in a position where you didn't necessarily need to sell any assets. And that gives you the flexibility. If you want to sell because of performance or underperformance more correctly, that's fine. But if everything's going great, do you really want to then sell a property? I mean, I come across this all the time, right? Where I might have a client approach us and they've got some great assets. We don't want to sell them, but we have to because of liquidity, because we want to fund retirement. So you want to avoid a situation like that. Also, the other thing to think about is changing lending standards, borrowing capacity circumstances. If I've got everything tied up in property, we've just helped a client just recently as this week, and they got themselves into a bit of a borrowing capacity issue. They've been tax clients for nearly 20 years, and they were previously financial planning clients as well. So they've done really well, but managing borrowing exposure when circumstances change can be a challenging thing. So you don't have that issue when you're in shares, of course. So there's lots of reasons for some geographical diversification, and maybe you could kind of split it. Maybe just go one house in Melbourne and then build some liquidity in the fund, and maybe try and add to your share portfolio as well. So I think building some liquidity outside of super, whether you want to do that in offset accounts, whilst interest rates are not high, but reasonable, wouldn't be described as low, either or. But I think probably more growth assets, given your situation's really strong. I don't think debt reduction's necessarily a focus. I think adding more growth assets would be a good idea. So maybe one inside super, put the rest into shares so you've got some liquidity and less gearing inside super as well, because we know, you're not going to get the negative gearing benefits and you're on a higher income. Or just keep the super in shares and leave it ungeared. But I don't think I'd go two properties, and try and build more liquidity outside of super in that share portfolio. So of course, that's not advice, Rob. That's just general information. Probably can't or don't want to add too many more comments beyond that. But thanks for listening to the podcast, and thanks for submitting your question. And thanks everyone for listening. And until next week, bye for now. Now, before you go, one last thing. My new book is called Wealth by Design. It's not a reprint of Investopoly. It's a complete and absolute rewrite based on what I've refined over the last 8 years. If you'd like to be notified the day pre-orders open and receive my pre-order bonus, register your email right now at investopoly.com.au/book. The bonus is a Investopoly research assistant. That's an AI tool that's trained on more than 500 of my blogs that I've written over the past decade. So you can ask it a question and it'll take you to the most relevant ideas and framework. And I'll keep feeding it all my future blogs too, so it'll become a tool you can use ongoing. Again, register at investopoly.com.au/book. Thanks for listening. I appreciate your time.